everybody doing on a Monday night?
I mean, you know what? You guys may hear some helicopters and noise in the background because it's the Lady Gaga concert at Wrigley Field tonight. So that is not where I'm at, but that is where everybody else is. So I'm going to go ahead and get us going. Welcome everyone to Money Mondays. You guys all know the drill. This is a realtor focused industry training. It's open to agents at all offices, and wanted to kind of start us off with an introduction of my guest tonight. So normally on Money Mondays, it is you get stuck listening to me and only me sometimes, and that can be overwhelming. I don't know it all by any means, but Marla is a longtime lender of mine. She and I have worked together for over a decade on so many different consumer transactions. She's an expert in renovation loans, in all different other types of loans that not necessarily every other lender is aware of. And so I thought I'd bring her on tonight because we focus so much at Exit Strategy on making sure that our agents are not only thinking about all the different consumer doors they can open with proper financing, but also for themselves. And we're all independent contractors. I'm paid as a 1099, as are all of our agents. Residual bonuses. Mike Schulte and I both are blessed to have a good number of them. Those come from Exit Realty International as a 1099. So we have clients, all of us, and I'm looking at a couple of people that are on already, that they have clients that are small business owners. Maybe they used to work for somebody else. So there's so many different scenarios out there. We wanted to open the door to not only more transactions for you as agents, but also for you to start strategizing how exactly you want to file your taxes smarter. Think about different ways that you're going to set yourself up in terms of, are you incorporating? What does all that look like? What expenses are you taking? What deductions? So I am going to go and share my screen, or actually, no, I'm going to allow Marla to share her screen.
I don't have a PowerPoint. You just get to look at me.
Tonight.
I know you love PowerPoint. Sorry.
All right. Well, we're going to have to trust you then to keep us on track, Marla. But let's go ahead then. And since we are broadcasting live on YouTube as well, we'll go ahead and get started. So Marla, if you want to kick it off from your perspective, maybe just a general bird's eye overview of independent contractor and small business transactions when you're buying real estate.
Yep. Also, I'm fine with interactive. So if anyone has any questions, feel free to jump in. I don't know if there's a way that someone can monitor YouTube questions. I'm not sure how that part goes, but yeah, if anyone has anything, feel free to jump in. Interactive is always good. Before we get into the specifics of self-employed clients, whether, again, like Nick said, it's for yourself or your clients, there are a couple things I want to highlight first that are, I would even say, more important than the specifics of the self-employed details. And some of these may be obvious, but I know at Exit there's a lot of newer agents too. So for some of you that are newer, these are really important things. For those of you who have been around a while, I'm sure these are not new information. But the first thing is, it's really important to have a good loan officer, a good mortgage company, especially when you're doing things like self-employed, renovation, investors, all these unique. All loan officers are not the same. Some have more experience and knowledge. Some are more skilled with calculations. Obviously, when you're looking at tax returns and all that, there's different calculations needed. Some loan officers, some of us are just nerds and we study the loan guidelines, so we just know that stuff better. I'm sure you guys know there are some loan officers that are great salespeople. They'll wine and dine you, but you give them a difficult file and that's just not their expertise. So it's important to have the good loan officer, but also the good mortgage company. You can have a good loan officer at a bad company, or a bad company, did I say that bad loan officer at a good company, and either of those combinations are not going to be great. Some companies just don't offer as many programs. They have stricter guidelines. They just don't have all the things you need, especially with these specialty situations. Now, if your clients are vanilla, they're all 800 credit score, 20% down, conventional loans, you'll probably be fine at any company. But if you have these type of clients, you need to be partnering with a good loan officer at a good mortgage company. And that's really going to pretty much solve everything. So I'm going to still tell you about the self-employed stuff so you guys know. But if you have a good loan officer, I mean, you just pass it and, and you're good to know. You're good to go. One other thing that I want to mention is be careful what mortgage information you're sharing with your clients or prospective clients. It's good for you guys to get this education and hear it and learn about it. But I would caution you not to get too in depth with, get in the weeds as far as sharing guidelines, telling clients your minimum credit score should be this, your down payment should be this. Use the information you learn to attract clients. Use it as a marketing tool. Share little kind of tidbits like, hey guys, I learned there's a great program for self-employed. Hey guys, I learned there's a great program for investors or for renovationalists. Use that information in your marketing. But I would never get into the weeds with the specific guideline details. And there's a number of reasons you could be misquoting that. You heard it from some loan officer and, their company has stricter guidelines, or it was a situation that applied to that client, or that particular loan program may not apply to everyone. So I would just caution you guys with being careful about oversharing mortgage stuff and really just staying in your lane, using the information as appropriate for marketing, but not try to have that conversation with the client. Pass them as soon as possible to your preferred loan officer, who's going to be the one to get in the weeds and tell them all those details and make sure it's accurate. Loan guidelines haven't changed since you last heard about it. So, okay, so those are my two main points to start out with that, again, I think are probably more important than even the specific details about self-employed people. Okay, so first of all, let's just define what is self-employed for mortgage guidelines, because definitions of things can vary based on common knowledge, based on accounting, based on legal structures, based on mortgage. So today we're talking about the guidelines and the rules specific to mortgage loans. And there are a wide variety of mortgage loans, and some of them are different. So some of these are sort of generalized or for the more common loan programs. So typically for most mortgage programs, if you own at least 25% of the business. So if it's a C corporation, an S corporation, a partnership, if you have at least 25% share, you are going to be treated as self-employed. Now, of course, if you are Schedule C, you file your income on Schedule C. So that would be like an LLC where you're the only owner, you own 100% of the business, or you're a sole proprietor where you're not incorporated at all, or a 1099 independent contractor. Those obviously you own 100% of the business, so those fall into that category as well. And this will be taken into consideration if it's your primary source of income, or in some cases it's a side job. Some of you may have a regular W-2 job and you do real estate on the side, or your clients have side businesses that they're starting. So that can all be looked at a little differently too. One thing we do look at is we're going to verify the existence of your business. So whether it's on the Secretary of State, if you have an official license, whether it's a Google search to find your business page. Sometimes we'll have your accountant write a letter to verify, yes, I can vouch for this company. They've been in existence for this long. Or sometimes certain type of businesses really don't have any online presence. They're hard to find. And you can sometimes use other things like client statements or things like that. But most of the loan programs do want to see that you have a 2-year history of being in business. There are some exceptions to that. So what I would say, again, if you have a good loan officer at a good company that has a lot of loan options, you always want to run every scenario by them, because there are always exceptions to different rules. There are unique loan programs that allow certain things that a traditional conventional loan might not. But most programs, I would say a good rule of thumb is 2 years. If it's been only 1 year, again, on a case by case, they can sometimes allow that. For instance, let's say you've been 1 year as a 1099, but prior to that, you had a W-2 job doing the exact same thing. For instance, I see this a lot in marketing. Marketing companies, some are W-2, some are 1099, and people tend to change jobs every year or two. So they can bounce back and forth between that W-2 and 1099. So if you had a W-2 job for a year doing marketing, and you have a 1099 job for a year doing marketing, and the work is the exact same, that's the kind of situation that you may be able to get an exception on, because the main things that underwriters are looking for, as far as, that this is a stable career and your income's stable, you're going to be able to show that across the W-2 and the 1099. So again, I would never tell a client, oh, you don't have 2-year history. don't even bother. I would always get that look. And to be honest, even if the answer in their situation is they do need a 2-year history, they can still have that conversation now and get on the right path and know exactly what to do. So they know by the time they hit that 2 years, they're ready to go because they've already had their taxes reviewed, had a coaching session about what's important and how to set themselves up to qualify, worked on their credit if they needed, saved down payment money, whatever those other things are, we can still get them on the path. So once they hit the 2 years, they're ready to go. So I would never limit, oh, I don't think you're going to qualify, don't bother. I would still get them moving forward. And I think that's Nick's strategy usually too. You always want to get people in the pipeline so you can have them on the right path to be ready to buy in the future.
Well, I think one of the things that a lot of people don't think about is what you and I talked on the podcast the other day. I had the advanced knowledge of a couple things only because Marla and I had we did a radio interview together for my podcast show, and she was mentioning that we know a lot of people take a lot of deductions, and as independent contractors, small business owners, there's that push even sometimes from your CPA, and we're not tax consultants, that's not our specialty, but we know people tend to, okay, well, I'm going to put my cell phone in there. I'm going to do this, and I'm going to take a home office deduction. And all of a sudden you look at your buying power and it's significantly less. And so this can be a multi-year chain reaction that you set yourself up for. So the more we can get education out to the consumers, and even again, for us as agents buying real estate for ourselves, we need to be conscious of what we're doing and making sure that we're not shooting ourselves in the foot, so to speak, when we are filing our taxes, as far as shrinking that buying power.
Yeah. And I mean, honestly, my recommendation for that is just to file what's accurate. The problem is that it's not that people sometimes don't make enough money, but they wanted to file in a way to reduce their tax liability, right? And so, like for instance, sometimes people this isn't as common now because people in the service industry, their tips are now more often on their actual paycheck. But it used to be when they get cash tips, they would claim the W-2 income on their taxes. And some of them would not claim the tip income because they didn't want to get taxed on it. And so they were trying to avoid taxes. But now on paper, your income is not reflecting your accurate situation. So we're not suggesting that you commit fraud and, claim more income than is real, but that you actually do file the accurate stuff rather than focus on reducing taxes. So there's two pieces of that, the income, and then like Nick said, the expenses. So with the expenses, I mean, people write off everything. I mean, I in the podcast I mentioned I'd seen one case where someone wrote off their expenses for their dog, calling it security. It was their home security system or their office security system. So it was like the dog food, the vet bills, like all this stuff. It's like, okay, come on, like you're paying for your dog either way. You're just trying to get a tax deduction, and you're hurting yourself if you're trying to buy real estate or use your income to qualify for anything else. But one more thing that Nick mentioned that's really important is you mentioned like home office expenses. So this is actually really important. A lot of people don't know this. A lot of the deductions that you claim, I don't want to say a lot, but some of them are what we call paper losses. They're not actual expenses. Like your home office expense, you're paying your mortgage, or hopefully you're paying your mortgage, whether you're running a business out of the house or not. So it's not really an additional expense you have. So we know that it's kind of fake. It's just for tax purposes. It's a paper loss. It's not really an additional expense you have in real life. So we actually don't penalize you for that. We add that back to your net income. And so there's several of those. There's depreciation. Obviously, as realtors, you guys probably don't have a lot of depreciation or depletion, but certain type of businesses where they have a lot of materials, a lot of equipment, like a landscaping company, they have all the lawnmowers, they have the trucks, they have all these equipment, a lot of that they depreciate. And so that actually cuts a lot off their income, and their income looks low, but we can take that and add it back because we know it's just a paper loss for tax purposes, and we don't penalize you for it. But the one that you guys see a lot as realtors, which is important to file correctly, because I see people file it wrong all the time. And this also goes back to making sure you're having a good accountant that's not missing stuff, is your mileage, right? So some people claim deductions in, it's called like the car and truck, like if you're on Schedule C, it's like the second or third one, it's like the car and truck expense. But on page 2 of Schedule C, you have to claim the mileage that you use that vehicle for business purposes. And when we're calculating mortgages, as far as adding back some of those losses, we go off the mileage, not the amount you claim. So make sure that mileage is on page 2 of Schedule C. And if anyone does not love their accountant, I have several accountants that I absolutely would swear by. I know Nick has some great relationships too, but if you have a mediocre accountant, just don't let them screw it up for you, because if you are trying to buy real estate, they're going to cost you more in the opportunity cost of not being able to get the real estate than they're saving you in taxes. So make sure your accountant knows, look, I'm trying to buy real estate. I want my taxes to be accurate, but I don't want it to be overly, claiming every little tiny scrap of everything. That's really not business, and we're just stretching it to save tax money.
What about, so there's a lot of our clients that are, it's a gig economy now, of course, that's such a, I have a day job, some people say, but then I drive for Uber at night, or I have a small side business that's growing. How does that factor in when they've got both a W-2 and a 1099 or small business?
Yeah, so anytime you have multiple sources of income, again, this is going to be generalized, most loan programs, but there are some specialty loan programs that I'll tell you about a little bit later that have different rules. But so this is generalized to most loans, like a traditional conventional loan, for instance. Most loan programs, if you have multiple sources of income, that is fine as long as you have a 2-year history. Because what they want to make sure is that you didn't just pick up a new second job or side business to qualify for the mortgage, and then you intend to quit, once you get the loan. So having a 2-year history shows them that this is something you actually do on a regular basis, and both income sources are stable. We can see the history on them. We can calculate them. So as long as they've been doing it for a while and it meets the other requirements as far as stability and consistency, it's fine to have multiple sources of income. But if it's not consistent, that's where it becomes a problem. You've only had it, the one job 1 year and you had the other one 2 years, or, you can even have you need a 2-year history of having both, but not necessarily those. So let's say you do have a self-employed business you've only had for a year, and your W-2 job you've been on for 5 years. So that's not a 2-year history, but let's say before your current self-employed business, you had a different self-employed business for a year. So you still have a 2-year history of having a self-employed business and your job, even if it wasn't this one. It's just a 2-year history of the idea of having 2 income sources that you've been working. So that's 100% acceptable.
So we've got a couple people that are popping on YouTube as well, which is great. So we've got people kind of on both venues. I'm monitoring us for questions. Tracy, I will send you one of my CPA favorites. That's Tracy's iPhone. Let us just shoot me a text or let me know which Tracy it is from our office. A few, and we've got some guests.
Levy.
I'm sorry, excuse me.
Tracy Levy.
Oh, I recognize that wonderful accent of yours. Yeah. Thank you. I'll send that right over to you.
Thank you, Nick.
So Marla, you did mention some of the programs that are out there, which I was blown away by some of what we talked about on the podcast, and also what we were discussing with the HELOC option. If you've already got a property that's got some equity in it, if you want to go into some of those programs, I found that eye-opening.
Yeah, I actually want to cover a couple other topics before I get into the programs, just because we're jumping around in my notes and I don't want to miss stuff. Let me talk real quick about the documentation that you need when you're qualifying as self-employed. There's one confusion people have about, one is like the number of years you've been in business. So like I mentioned, a lot of the loan programs want you to be in business 2 years, but the number of years of tax documents doesn't always have to match that. And people confuse those two things. So there are some loan programs where you only need 1 year of tax documents, even though it requires you to have been in business for 2 years. We don't necessarily need to all the time. And often that's more favorable because 1 year of tax returns typically is going to be stronger than averaging 2, because for most people, their most recent year of taxes is going to show a higher income than the previous year, especially right now with the pandemic. 2020, a lot of people were down. not in real estate, obviously, but a lot of other businesses. So, you know, as often as I can, I will go with the programs that only require 1 year of tax returns. And the best one out there is the Freddie Mac program, which some lenders don't offer. So if you're dealing with anyone self-employed, ask the lender before you create that introduction if they offer Freddie Mac loans and if they're very familiar with them, because Freddie Mac loans have a lot of little loopholes that Fannie Mae does not have. And using only 1 year of tax returns is one of those that is really useful. But if you are, depending on what type of self-employed, if it's an S Corp, LLC, all of that, we do need all of the tax documents. So the business tax returns, if there's K-1s, personal tax returns, W-2s, all of the information so we can calculate it, because we are going to factor in both your personal income from the business and the business income, because it's really all comes from the business. Some people will pay themselves a W-2 and a K-1, and it's really all related to the same thing. So we add it all together. And then just to clarify how the income is calculated, because people confuse this a lot too, is the number we're looking at is your net income. So your gross income is how much you actually made. So for you guys, you're 1099, but then you write off all your expenses. And the number at the bottom, when you take off the expenses, the net income is the number we're using, again, with adding back some of those paper losses we talked about before. But that's important that you're keeping an eye on the same box. A lot of people call me and say, oh, my 1099 said I make XYZ, I think I'll qualify, you know, and they don't realize that is not the number we're looking at. We don't care what the gross is if you've spent half of it on, you know, whatever marketing expenses or whatever else you guys are investing in. Okay, so let me get back to the programs that Nick is asking about. Oh, one other quick thing. This doesn't necessarily pertain to realtors as much, but for other types of businesses, sometimes if there are one-time expenses, like let's say it's a startup company and you had some major expense for a piece of equipment or something like that, you know, you don't need to buy that equipment for 20 years again. Once you bought it, you're done. Sometimes we can back those out and not penalize people for that as well. So it may look like a loss on paper, but if we know it's not a recurring cost that they're going to have every year, we may be able to back those things out too. So again, it does take a little bit of scrutiny to know tax returns, to be able to look at that detail, to find those things, to make sure we're in the most favorable situation of how we're calculating it and which loan programs we're using to qualify the client. Okay, so loan programs. Okay, so first we always start with, or at least my process is, I think most loan officers do this, we always start with the most favorable programs and then use a process of elimination to get to the ones that are less favorable. So if the person qualifies for a conventional loan, an FHA loan, a VA loan, we're always going to look at those regular programs first. And like I said, some of them do have more favorable terms where you can use 1 year tax returns, not 2, or have exceptions if you've only been 1 year 1099, but you have a 2-year history. So you always want to dig into those first because they're going to have the most favorable terms, the best interest rates, the lowest down payments, you know, all the things that we know that our buyers like, those are going to be it. So we're always going to start with that and then rule it out. If they don't qualify for one, what's the next? What's the next? Until we get to the programs that don't have as favorable of terms. So once we get out of those programs, there are jumbo loans for the higher dollar amount. And then there's a whole other sector of loans called Alt-A, which are basically just alternative loans. They're designed for people that for whatever reason didn't fit in a conventional loan. And so there's this whole private sector of loan companies that have created all these programs for people who specifically didn't qualify for conventional loans. And so there's a lot of these jumbo loans and alternative loans, and they all have their own guidelines. It's not like conventional loans where the rules are the same for all conventional loans. Every single company has their own guidelines, and some of them follow conventional rules for the most part. Some of them have their own rules. Some of them are pickier and more thorough scrutiny, but they all have their own guidelines. So there's not like an across the board that I can say, well, for self-employed people, jumbo loans require this. It's really like case by case. You really have to look at the guidelines for every program. But the rule of thumb is if the company you're working with, whether it's a direct bank, just a mortgage lender, a broker, whatever type of company you're working with, the more options they have, the more likely they're going to find a match for your for your client, right? So let's say it's a company that has, 30 jumbo loans versus some bank that only has 2. There's more likely in those 30, as they're weeding through the guidelines, they're going to find something that's a good match for your client, even if they have a quirky situation, for whatever reason, there's something unique about their situation that we need a lender that would allow an exception on something weird. Well, if you've got 30 choices versus 2, you're more likely to find that situation. So the alternative programs, or actually well, let me do the HELOC last. I know you asked about that. Sorry, I'm jumping around because my notes are not in the same order. But so the alternative programs are really, really interesting. If you guys are not familiar with these are really fun, and they really can get a lot of deals closed that regular loans can't. So if you send a client to a traditional lender that only has conventional and FHA and VA loans, and that lender says, oh no, you don't qualify. Well, what that means is that they don't qualify with that lender. That lender doesn't have a loan program for them, but that doesn't mean there isn't a loan program that might fit those needs. So you want to make sure you're not losing those clients. Personally, I think there's probably at least 30% of clients that are getting denied that could qualify for a loan, just not that loan that those banks have. So you don't want to leave those deals on the table. You want to make sure those clients are partnered with companies that have all these extra programs and loan officers that are going to do the extra work to research them and dig through the guidelines and try to find a good match for them. Because these are higher risk programs, again, because the client doesn't qualify for conventional, they are going to be higher interest rates, higher down payments. They're going to have additional requirements. So, it's not like a client, you're not going to get the absolute lowest interest rate, lowest down payment, all the best terms. But for some clients, it's still a better investment because they can own the real estate, right? So it's not something that I would say, oh, well, your interest rate is too high, just don't buy real estate. Well, I mean, the real estate is still an investment, so it may still be a good deal for them. So here are some of the alternative programs that I love for self-employed people. So the most popular one that probably a lot of you have heard about, especially those who have been in the industry for a while, is called the bank statement program. So yeah, I know Nick and I have done quite a few of these. So basically, I mean, it's really what it sounds like. We collect their bank statements, sometimes 12 months, sometimes 24 months, and sometimes it's personal bank statements and sometimes it's business. There's a lot of different variations within bank statement loans, but we literally add up all of the deposits in their bank statement, and that's essentially their income. Now, it doesn't mean we don't take into account expenses at all. They're different. Each of the companies that have the bank statement loan have their own rules. Some of them have set numbers, like if you're in a service industry job, we're going to assume your expenses are 30% or whatever. That's just an example. That's not the real number. Sometimes they have a set amount that based on your industry, they're like, this is the factor we use for expenses. Sometimes they want your accountant to actually write a statement saying, okay, based on this person's actual, profit and loss statement and their budget that I work with, I can tell you that their personal expenses are 40%, whatever it is. So we do still take into account expenses, but your gross income is literally the deposits in your bank account. And so sometimes that's a more accurate and sometimes more favorable reflection than what you actually put on your tax returns. So that's a super popular program. Another one that I like, but it doesn't work for everyone, is called asset depletion. So what this means is if you have a ton of assets, money in the bank, stocks, whatever kind of assets you have, sometimes if you have enough, we can assume that you have enough assets that you could use that money to actually pay your mortgage. So you don't need income at all. We don't look at your income at all. We're just like, you've got enough money in the bank, you can pay your mortgage. Some of those programs you need like substantial amount of assets. It's not just like, oh, to cover the mortgage. It's like, because you have to also pay your living expenses and food and everything on top of the mortgage. So sometimes it's like a formula, like based on the assets you have, you can use this percentage, or, they're all, again, slightly different. So often it's substantial assets, but there are some that are really like, oh, you just need to have more assets than the amount of the loan. And, again, those are going to be the higher risk programs, higher interest rate. But if your client has substantial assets, sometimes you can use assets instead of income. And it doesn't matter if they have no income or minimal income. So that's kind of a cool program too. Some of these alternative programs are okay with 1 year self-employed. You've only been in business 1 year, that's fine. 1 year tax returns, that's fine. Again, some of them, not all of them, but specific lenders, they target these things, but again, they understand it's higher risk, so there's a higher cost for it. Some of them will just look at your K1 or just your profit and loss statement. There's a lot of variables. Another one that I've become a big fan of in the past few years, I've started using it quite a bit, is the doctor loan programs. If you've ever used those, so whether it's a physician, a dentist, some of them even allow like chiropractors, there's a variety of things, and they have some really cool guidelines that are like, just ignore all your student loans. Just, I mean, like they really make it very easy because they're like, well, obviously it's a doctor, obviously they're going to make good money. So they try to make the guidelines as easy as possible for those people. And some of those doctors are, self-employed or a mix of, situations depending how their pay structure is set up. But those are cool programs. And then the last one that I want to mention in this alternative category, they have two names. Sometimes they're called investor cash flow loans, and sometimes they're called DSCR, which is debt service coverage ratio. But basically, these are investor loans. This is not for your primary home, but basically, as long as the property is cash flowing, or at least the rent is covering the monthly payment, being mortgage, taxes, insurance, the whole monthly payment. That's all they care about. They don't care about your personal income, your personal anything. It's really just based on the property covers itself. Cool, here's your money. Again, slightly higher down payment, higher interest rate, all of that. But there are these unique programs, and these are the type of programs that I think are really great in your marketing, right? Because you can just throw little things like, we have a cool investor program that doesn't look at your income, just throw out little tidbits like that. And people will start asking like, oh, interesting. I was interested in becoming an investor. So just throwing out little tidbits like that, like, oh, I heard about a great loan program for doctors that's really easy to qualify for. Just these are ones that are not as well known, obviously. So it kind of just makes you look like an expert in the field, like you have insider information, like you're well hooked up with, lenders that can offer more things than your potential consumers are familiar with. So I think these are great little marketing tidbits to throw out.
So I've got two questions for you before you move on. The DSCR, that was one I'd never heard of before. Is that so? If with that, in that scenario, you would probably be looking at properties with existing rental income, like existing tenants, existing rent rolls. It wouldn't be a estimated, with vacant units, correct?
It doesn't need to be, because on the appraisal report, whenever there's rental income, one of the pages of the appraisal report is the rent schedule. And so the appraiser is going to determine what they think market rate rent is, and we can use that. And that's actually sometimes better if there's like below market rent tenants in there, so the appraiser's opinion can be used. Now it gets a little tricky because the way the appraisers use comps is not the way you would use rental comps. So we would look at, apartments.com or Craigslist or places you find apartments more readily available than the MLS. And the appraisers are limited. They can't just pull Craigslist and say, yeah, it looks like you could rent it for this. So a lot of times they're looking at comps, like specifically, let's say you're buying a multi-unit building. They're going to look at comps that are other multi-unit buildings and what those rents are listed for. And that's a challenge because a lot of times those rents are either below market value because they're longtime tenants, or they're month-to-month leases, and they're not really accurately reflecting the market. So if we're using a program that's really dependent on the rent, that's where I usually coach the agent on how to run the comps the same way that the appraiser would. Now, of course, you run the comps the regular way to educate your client about the reality, but we also want to make sure we think that the appraiser is going to come in with the number we need. And that's not just these programs. Like when we deal with multi-unit FHA, you've got the self-sufficiency or renovation loans where you've got to figure out the after repaired rent, like how much you can rent it for after it's fixed up. So all of those, any program that's dependent on that rent being a qualifying factor, we just have to look at it the way that the appraiser is going to look at it, which unfortunately is not necessarily favorable.
If you think about it overall, everybody in the audience, we've got about a dozen people on YouTube now. It is, your interest rate on rent is 100%. And as a investor, your interest rate on not buying a property is 100% too. If you're looking at historically, rents have never gone down except for that 6 to 8 month period during COVID. you know, if we were sitting there waiting for you to have 2 years tax returns as a business owner versus maybe going into one of these alternative programs with a higher interest rate, but still you're in there, you're solid before prices go up anymore or rents go up and you miss out on opportunity. It really, to me, I'd rather look at it in the long term of things. And correct me if I'm wrong, Marla, but you could always refi out of.
Right. That's what I was going to say. Right. So if some of these, I will coach the clients on having a multi-step plan where this is the best option for you today, but in the future, you can do this other thing. Now, of course, we don't know exactly what rates are going to be in the future, so there's a lot of guesswork there. But yeah, if someone refinances to a conventional loan after they have that 2 years, they can potentially get better terms. I mean, I always tell them, though, of course, there's no guarantees, or I don't have a crystal ball, so I can tell you what I see in the market and what the experts think and what the economists are, projecting. But I always am like, I want to make sure you're comfortable with what you have today in case you can't refinance. But we definitely want to keep our eye on that. Now, one thing that's a little bit of a downside is some of these alternative programs, they have what's called a prepayment penalty, which means if you do pay it off either via refinancing or whatever, you sell it, you win the lottery, whatever, if you pay it off too soon, you may have a very large penalty fee to pay. And again, like Nick is saying, it's a question of the opportunity cost, right? So let's say you pay a penalty fee, but you're saving, a certain amount of money. You want to look at the long-term analysis of that. Same thing like Nick was saying, the opportunity cost of not buying versus buying with a higher interest rate, it's going to cost you this, but if you don't buy, what is it costing you in the profit that you could have earned in that time? So you always want to look at the trade-off. People get stuck in just one narrow focus, like this is the interest rate, it's too high. It's like, okay, but how much are you paying in rent? You've got to take your clients out of the narrow focus of really having one objection and say, well, what it's really costing you, and that opportunity cost is the official phrase that economists use. What is the opportunity cost of not paying this? Even my biggest thing I talk to people about is PMI. A lot of people are like, no, I don't want to pay PMI. It's a waste of money. I'll wait till I save 20%. And it's like, okay, well, you wait till you save 20%. In the meantime, how much equity did you miss out on gaining? And also the value of the property went up. So now you have to pay how much extra to buy that property. So ultimately, the cost of waiting is more than the cost of the PMI would have been. So I never tell someone to wait to avoid PMI, because you're typically, in most markets, you're going to make more money than you saved by PMI. My favorite story about that is I had a client, I think I told this one on the house hacking training that Nick and I did. I had a client who came to me and she told me she wanted to buy a condo. She had 20% down. She wanted to avoid PMI. And in talking with her, I found out that her dream was really to buy a multi-unit building. But she didn't think she could do that because she didn't have enough for 20% down for that. And she really wanted to avoid PMI. And after we ran the numbers, I mean, it was just a clear, like the spreadsheet always tells the truth. It was a very clear decision. So she ended up buying a 4-unit building. She lived in one. The rent on the other 3 covered the entire payment of the building. So she literally lived for free, but she had to pay PMI. So I'm like, well, if you bought the condo, you'd be paying PMI and you'd be paying $2,000 a month. And now you're living for free. Like, you think that the cost of the PMI wasn't worth living for free, and now you're saving $2,000 a month. Like, it's just, people get really hung up on one specific objection, one specific number, and they don't know how to look at the bigger picture of that opportunity cost of what they're missing out on if they don't move forward.
And just knowing their different options, and figuring out what is, and it is not always the right time to buy for everybody, and that's also goes into supply and demand of what's out there. But we have that tool at our office for our agents, which gets their clients all the private listing network listings. I have a guy that, he did a loan on a multi-unit building, and he's got the rents now up 20% from where they were last year when he bought it, with just really basically cleaning the place up, not doing any substantial renovations. And in the meantime, his equity's gone up. And it's like, wow, if he had waited another year to do this, that opportunity would have presented itself. He needed a certain type of loan product, but also he needed a certain type of inventory that sometimes we as agents need to dig. So it's the right lender, it's finding the right property and really, but having that pre-approval from the lender, knowing sometimes it's a matter of cleaning up some credit or preparing to file the taxes in the right way. This is it's a long game. Real estate is always a long game, but you've got some activities to do quickly in order to get the process rolling, because otherwise it's always, oh, I'll get to that next month, I'll get to that next year. I've missed out on a lot of real estate opportunities. Marla knows sometimes, because everyone's gonna be like, hey, can we check into this? And then it's 6 months goes by and prices are up. I have no new asset that I could have had if I had moved on it. And so prioritizing time blocking as a consumer to make the time to be with somebody like Marla, and then go back to your CPA or your tax professional or your employer, and, you know, or figuring out, do I need a side game? You know, do I need some extra money to get me to 20% down or whatever that loan product is? And Marla, I had one more question for you about interest rates. I know each program is different, but on average, what are you seeing as a higher interest rate? What's the margin between a conventional type product and then these alternative products? And I know that's a wide range.
Yeah.
It's not a one size fits all answer, but just give me
no, it's a very wide range. I was looking at that investor cash flow program for a client a couple of days ago, and now she didn't have the highest credit score, so she wasn't in the top tier, but that one ended up being like in the 8% range. And the problem with that wasn't that she was opposed to paying it if it made sense, but it made the monthly payment so high that the property would have been a negative cash flow. So at that point, it kind of like was a chicken and an egg, where it was like the rate was affecting the cash flow. So if the cash flow had been good, she didn't care about the rate, but they interplay, and so it made the deal not worthwhile. They're not all going to be that high. Some of them also don't have fixed rates. They have adjustable rates, which again would be great for a two-step plan, where it's like, this is in the door and we're going to plan a refinance. And that's part of that strategic planning. So whether it's strategic planning, how to buy your first property, where it's like, all right, this is what I need to do with my taxes, how much down payment to save, do I need to pay off debt or shift debt? If you guys have heard me talk about shifting debt, I do that a lot. But so that's strategic planning for your first property, but also your strategic planning for your long-term goals. If you're looking to build a real estate portfolio, how does your first property affect your ability to buy your next one? And thinking of that right at the beginning so you can set yourself up. I had a client just a couple of days ago I was talking to who qualified for an FHA loan. He had a multi-unit property under contract, qualified for FHA 3.5% down, but wanted to put 20%. And I said to him, I said, well, is it your goal to build a real estate portfolio and buy more real estate? And he said, yeah. I said, well, if your money's stuck in that property, that's down payment money you don't have. If you do the lower down payment, you have the rest of that money to use for a down payment on the next one. Unless you have such a high income job that you can save a down payment for a new property every 6 months to a year, why would you have your money sitting in the real estate? Because your equity in the real estate is not the thing that's earning you profit. It's the real estate itself, regardless of whether that equity is sitting there or not. So just doing that sort of like bigger picture strategic planning to make sure you're setting yourself up not for just this one transaction, but for any future transactions, any future goals, and really, just have the big picture. Or things like FHA, you're going to use an FHA loan, but you can only have one FHA loan at a time. So the next one, are you using FHA, or is there another option? Or can we refinance the FHA one to buy the next one? Like all those little details, you can have plans laid out. And sometimes it's like plan A, plan B, plan C, because we don't know where the market's going to be, what the values are going to be, but you can have an idea of how you're going to get to the end goal, and just have that strategy laid out in advance. Like I'm a big fan of strategic planning, and in advance, like if a client says, hey, I'm not looking to buy till spring, great. This is the perfect time to do strategic planning. So when spring comes, we know you're in the best position to get the best terms. You've got your credit on point, everything is set up. So I always like at least 3 to 6 months in advance, 9 months. Don't let someone tell you I'm ready to buy in spring and then say, okay, fine, I'll call you in April. That's, may work, but they don't have time to do any of that strategic stuff if there's ways that they can optimize their situation.
Exactly. And I want to share my screen just for 1 second, because Marla has brought up a couple times the topic of strategic planning. And this is for those of you guys at Exit Strategy, where Project X is my coaching program. This is basically the 4 quadrants, because we do everything in 4 quadrants in the program. This is, okay, setting up criteria. Where do you want to be? What do you want to buy? Cash flow. Do I need to make more money? Do I need to cut expenses? Credit. What do I need to do to keep my credit score up or raise my credit score? And then capital. Where do I need to sell an asset? I've had people sell boats, cars, to either get rid of debt or get that cash flow back for them. So there's things you can do. I've got a friend that he's renting out his parking space using, I think, Spot Hero or one of those Parkways. So he gets the extra money out of that. I'm like, there's a lot you can do. But if you're not planning now, what you just said, Marla, was genius. Don't, if you're ready next spring to do it, start planning now. And, this spreadsheet, all of our agents have access to this. It's great for clients. It's also great for us because we're so, I think sometimes in the moment, but it is again, real estate is a long game. So
I would say, importantly, sit down with your mortgage professional and do that together, because there are some ideas you have that might actually not play out in your favor. Like you're thinking, oh, I need to pay off this debt. And we look at it and go, no, it's actually better if you save that money for down payment. Right. So I would definitely get some feedback on the finance side, take the time to lay out what you guys think, but then show it to someone on the finance side and say, is this the best way to get to my goals? Or do you have other ideas I haven't even thought of yet?
I love that. Well, this has been already super, super valuable for.
Can I go back to the HELOC? I forgot to answer your HELOC question. Sorry, I get distracted.
We're, guys, we're not done. I mean, I'm not going to the Gaga concert. I can think I hear it down the street though.
I'll be quick. But that's part of the strategic planning, is talking about the equity in your current home, and if you can leverage that to buy more real estate or invest in other things, however you want. So whether it's a home equity line of credit, a cash out refinance, a bridge loan, there's lots of ways to consider your current real estate or even current other assets. Can you take a loan against your 401k account? Do you have a life insurance with cash value you could take a loan against? So yeah, that's part of the strategic planning. So keep it short.
No, I love that. Question for you real quick. What is the difference? Because I was sitting on, one of those Google, web links, and I'm like, I don't know if that's as good as Marla to answer my question. The difference between a home equity line of credit and then a home improvement loan. What's the difference between those?
So home improvement loan doesn't really imply what type of loan it is. So it's more like, how for a marketing perspective, they'll give a cute name to something. So they just say, oh, home improvement loan. It doesn't really mean what it is. So there are some companies that have home improvement loans that are just personal unsecured loans. They're not even attached to the real estate. Some of them are home equity lines of credit, but it doesn't actually imply what type of loan it is. In general, loans that are attached to real estate are going to have better terms than just an unsecured loan. But it depends on the lender. One of the lenders I work with, or one of the banks I work with, has a home equity or a home improvement loan is what they call it. And it's just an unsecured personal loan. It's not even a lien on real estate. And it actually has really good rates for the fact that it's unsecured. So yeah, there's a number of ways to get equity out of your property. And there's also different ones have different maximums. So some home equity lines of credit will go up to 90% of your value. Cash out refinances may only go up to 80%. So there's different nuances based on how much money you want, whether it's fixed, whether it's variable, whether you have a really good interest rate on your current loan. So you don't want to lose that by doing a refinance. So you just want the line of credit to avoid that. There are actually fixed rate home equity loans that are different than lines of credit. They're fixed, but typically they're higher interest rates. So people like the lines of credit because they have lower interest rates, and they're variable. People like that's not the word I was looking for. They're revolving is the word I was looking for, where you can borrow money, pay it back, borrow it, pay it back. So if you're investing in real estate, you can take it when you need it, versus a loan, you get the money, it has to sit in your bank, and so you're paying interest on it, even if you're not using the money yet. But a line of credit, you just take it when you need it. And then when you're done with that project, pay it back, and then you can borrow it again. So even if the interest rate is a little higher, the interest rate is variable, the fact that you're only paying interest on the portion of money you're borrowing while you're borrowing it, typically makes the overall cost lower. And lines of credit, you can sometimes, like I said, go up to 90% of the value instead of 80. So you can leverage more of your equity. So yeah, I like lines of credit. Personally, I have lines of credit on every single one of my properties because I like leverage. I think I like using money to make money. It's what banks do to us. It's what, we do if we're smart.
And that is why I've always enjoyed working with Marla. She's an investor as well as a genius in the mortgage space because she has been an investor. And you've got to deal with people that are in the trenches with you, so to speak, that are also watching the market with that knowledge of, like you say, that if there's other people's money, OPM, they say, to do something, you've got assets sitting here. Sometimes you're the asset. Maybe it's going out and getting that second gig at night, or just sitting like I do in my home office sometimes going, what can I cut costs on? What can I do better or make more, strategize in advance, and then start watching the market. But you've got to know what these different loan products are, because as Marla and I said on the podcast the other day, if you walk into blank national bank, the big box retail banks, and say, hi, I'm Nick, and I'd like to, I'm a self-employed person and I want to do XYZ. A lot of times they will tell you very little as possible, particularly if you fall into that less than 2 years, or you've got some not so great years in business, that you've got some losses or some reduced income on the business. And, if you walk out of there, you think it's all over. And in reality, you just have to know what loan products are out there and if they're right for you.
Mm-hmm. Yeah. I always say that, like the regular, like a big box bank, like you said, when you go in and ask for a pre-approval, they have two answers, yes and no. And like I said, their no is much stricter than a lot of other companies. So when someone hears no, they think that means they don't qualify for a loan. And all it means is they don't qualify for a loan with that company. So you're leaving those 30% of deals on the table because it's not a lender that has the right tools for them. But also, like a good loan officer, in my opinion anyway, will not have, they'll still have two answers, but they're not yes or no. They're yes. And then the other option is not no, but how do we get you to yes? So a lot of loan officers don't do that strategic planning. They just look at your numbers and say, yeah, you don't qualify. Call me when you qualify. And they're not going to sit down with you and say, okay, I need you to do this, this, and this to boost your credit. I need you to shift this money over here so you have enough down payment, enough reserves. That strategic planning is not a normal part of the loan officer job, and a lot of loan officers don't even know how to do it. They don't think like that. So I mean, again, if you're into this, if you have only vanilla clients, you're probably fine at any lender. But if you have these alternative needs, I mean, it's just important to partner with someone who's going to help you capture that extra 30% of the business that is on the table right now, but then also that extra business of people who are not ready, and get them in the pipeline for next year. So then you have another 30% of business, of things that are in the pipeline for next year. And as long as you follow up, stay in front of them, do your social media stuff, they're going to remember you when they're ready to go, and hopefully if you're working with a loan officer that is sales oriented, they're going to push them back to you too, because they are also following up with them, staying in touch, and they're like, oh, good, your credit, you're ready to go. Don't forget to call your realtor, Nick, so you want to make sure to keep those people in your pipeline for the future, rather than just focusing on the current shiny object of what's in front of you right now, but really figure out how to capture that extra business and the future business.
Absolutely. Marla, do you have anything else that you would like to bring up as topics on this? Because I think I definitely want to, have you back for some future information pieces as well. And I also want to make sure we get your contact information for everybody, because I know there's some realtors that are not, not in with the best lenders yet, and we want to get them in with the right people that have the right tools for them. So is there anything else you'd like to bring up? And then also please give us your contact information.
Yeah, I just want to do a shameless plug. So if you're not following me on Facebook, I have started doing videos. Some of them are things you can learn from, and some of them are things that you can share to your prospective clients or on your walls to try to attract people. So I've been trying to do once a week. I'm getting better at it. And I'm also trying to get better at making them shorter form. I tend to ramble on a bit, but there are some good ones. I did one about 10 things to know about the current market, and it talks about why it's a great market for buyers. It's not about interest rates are too high, all of that. I did one about the easiest way to boost your credit score without spending any money. So if you're not on my business page, you can also follow my personal one if you want, but my business page is where I do the videos. And yes, I will be migrating to Instagram and TikTok at some point, probably when Probably when they're no longer cool, I'll finally get there. But right now it's just on Facebook. And then I also started a group that I'm going to start doing more videos on specifically for realtors to educate them on renovation loans. So if you join that group, I'll be starting to do more videos on renovation loans to break down that information. As far as contact info, I don't know, what's the best way? Can we just like put it in the comment or something?
I would say just repeat it twice because we've got YouTube and Zoom going. So I think if you just say it, then everybody's going to be able to write it down.
Okay, cool. Phone number is 773-617-2424. So again, 773-617-2424. Email is Marla, which is with an L, it's not Maria. I know a lot of people do that. So MARLA.Barch, B as in boy, AR, C as in cat, H as in Harry, at mycc, so just the letter C twice, myccmortgage.com. And either of those work. I also have a Calendly if you guys want to schedule an appointment just to chat about your own business or, you know, get some strategic ideas about how we can collaborate to help more of your clients get approved. So it's just calendly.com/Marla's Mortgage Team.
Well, we love Calendly, and that's how. If those are you, so we've got some people on the YouTube that may not yet know, you know, kind of where they want to go in their real estate career, or that they're in a potential investor or potential buyer, and they need a great agent. Well, Exit Strategy has career opportunities for agents. We can show you how to make more money, save more money, invest in real estate, all that good stuff. And then also for consumers, we've got some amazing agents all over the city of Chicago, the suburbs of Chicago, and a nationwide, actually an international team all over. So I do have a Calendly as well. I'm going to just share with you guys real quick. And obviously, if you later on are like, well, I just couldn't figure what Marla was saying, even though it was very clear with her cell phone number and how to get a hold of her. I will tell you, if you go to teamlibert.com, which is my little link tree page, you have all my audio stuff at the top right here, where it is a let's see, that's my YouTube channel, Instagram. I am on there, even though my TikTok is terrible. So don't go to the TikTok yet, guys. And then this little cloud with sound next to it, that is my SoundCloud. Actually, I very rarely talk about my podcast, but I actually have, you can hear all the time me talking about the little TV show that I have on the Travel Channel once a month, but I actually have an entire podcast, which it features great people like Marla, stars of Exit. That's all of our agents that hit at least 100,000 GCI in the year and cap out. And I've got things for consumers, mortgage financing options for independent contractors. That's the most recent one. That is with Marla as my guest, and a lot of great information. So Marla, thank you so much for taking time out of your Monday night to be with us on Money Mondays. Everybody else, please come back and join us again for Money Mondays. We will continue to do these every Monday night for realtors, and we've got some great events for consumers coming up. So guys, thank you very much, everyone, for being here. If you are anywhere near Wrigley Field, go out on your rooftop or walk outside and enjoy the concert with me. Have a great night, everyone. Thanks again, Marla.